Since hitting its all-time high on January 5th, 2022, Advance Auto Parts, which reports earnings this week, has grossly underperformed the S&P, even as two of its most well-known competitors, AutoZone and O'Reilly, outperformed significantly. We're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. Please put your questions and comments into the live chat and we will try to answer them. First, though, I thought we might talk a little bit about the auto parts business. O'Reilly has seen a total return of almost 78% since that January high for Advance Auto that I referenced. AutoZone is up 53%, and the S&P 500 more broadly is up about 33%, actually a bit more as of today's close since that time. AAP has fallen more than 80% since then. Although Advance Auto was the smallest of the three at the end of 2021, these companies are still ostensibly within the same order of magnitude. They sell similar products. Advance Auto did about $11 billion in revenues, operating about 5,000 stores. That was the number of retail outlets that they had at the end of 2021, with about 40,000 employees. AutoZone, which is the largest of the three I mentioned, and I didn't really get into Genuine Parts, which runs Napa, did about $14.5 billion. They had 7,000 retail locations, and O'Reilly operated just under 5,800 stores. Revenues at AutoZone and O'Reilly have grown in the high single digits per year, with profit margins averaging about 14.5% at both companies. But Advance's top line has stagnated. It's actually declined on an inflation-adjusted basis and has net income margins of about 1% or even less in some quarters. So it's barely turning a profit. So between the company's poor operating performance and the stock's sharp declines, it's unsurprising that sell-side analysts aren't enthusiastic about it. Advance Auto has only 3 buys, 22 holds, and 3 sells. To put that into perspective, sell-side analysts generally rank the company, so when we think about it, holds are often thought of as sells. So, most publicly traded companies, the sell side, there's going to be more buys than holds, probably more holds than sells. But in this case, what we can do is we can take a look at everything within the Russell 1000 and say, okay, well, where would this rank on a decile basis in terms of how generally bullish or bearish the sell side is. And in fact, it ranks in the bottom decile within the Russell 1000 generally, and also within the bottom decile of the consumer discretionary sector more precisely. AutoZone, which is the highest ranked of the 3 that I'm mentioning, is in the 80th percentile within consumer discretionary. So sell side analysts are generally more bullish than they are for the average company in consumer discretionary, and they are more bearish on Advance Auto within consumer discretionary. So a potential cause of this really big underperformance is corporate management. We have similar businesses with very dissimilar operating results. So it's reasonable to assume that maybe a shift in management strategy can turn around an underperforming business. And so they seem like a good candidate for this. And if we take a look at some of the holders of Advance Auto Parts, a couple well-known activists show up. So we'll just take a quick peek here. Maybe the most well-known is Third Point, which we can see right here ranks as, it's the 11th largest holder. They're a well-known activist. And, they recently made some changes to corporate management. So they hired Shane O'Kelly. Shane O'Kelly, he used to run supply at Home Depot up until late 2023. So he joined the company almost exactly a year ago. And one of the big, allegations might be the best way to say it, about Advance Auto Parts underperformance has been that their supply chain distribution has just been a whole lot worse than it has been at their competitors. Now, they haven't done a whole lot to improve it necessarily, but one of the things that activists often will call for is they, are often looking for strategic alternatives. They want to sell off portions of businesses or sell the entire business. From time to time, you might have a suggestion like that. Now, with respect to selling the entire business, we have a change in administration. We're going to have a change in the FTC chair. So Lena Khan's going to go away. It is reasonable to assume that the incoming administration is going to be more friendly, probably, to corporate mergers and acquisitions. But in the meantime, Advance Auto actually has already begun to do this. So they had a portion of the business called WorldPac. They agreed to sell WorldPac for $1.5 billion to the private equity firm Carlyle. That deal closed last week. And the company is reporting that net of tax considerations and fees and so on, that they should net about $1.2 billion from the sale. That's important because if you're going to try to fix things up, you probably are going to need to make some investment. They have committed to investing about $200 million worth of those proceeds into supply chain enhancements. Now, I would make the following observation. So the way this thing came onto my radar in the first place, not that I'm really following the auto parts business that closely, but it just struck me as remarkable that you have these businesses that are so similar in some sense, retail stores selling auto parts, but you have net operating performance that is in fact so different. So to put things in perspective, you're dealing with a net income margin, let's just call it 1% on sales of $11 billion. Then you're going to be doing about $110 million in net income. Compare that to AutoZone, which is, I would say probably regarded as the best in the space, even though O'Reilly has actually outperformed it. And we're going to get to a trade on this in a moment because the options market is implying some very big moves for Advance Auto. So on, call it $19 billion, they're going to do $2.6 billion in estimated net income full year this year, 2.8 for their next fiscal year, which actually ends at the end of their fiscal year, ends at the end of August. So the way I look at it from a turnaround perspective, they don't have to get anywhere close to the kinds of performance that O'Reilly and AutoZone are seeing to actually, have a lot of upside potentially for shareholders. Potentially. So let's think about this for a second. Let's assume that Shane O'Kelly can start putting some things in place and can actually start getting these margins up, not to the 14-15% that O'Reilly and AutoZone are seeing, but maybe they can get it up to, let's say, 5%, right? So 5% on $11 billion, and now you're talking about more than $500 million a year in net income, $600 million a year in net income. The company's worth about $2.4 billion. So, we could take, let's just take a $500 million number, and then assume that you can maybe get 17, 18 times, which is less than a market turn for it. You're getting up to about a $9 billion valuation at that point. So what are we looking at? A 3, 4? If they really started to execute, if they got anywhere close, a 5-bagger potentially. So, we talk about different kinds of trade ideas here. We look for companies that are growing the top line. We look for companies that might represent a better value to make a certain type of secular play. I think one of the examples I was providing, and as you know, I don't generally like shorting stocks. I think Tesla is arguably a great example of this because one of the things I had highlighted was that I thought if people were looking to make an autonomous vehicle play, that General Motors, because of their ownership of Cruise, might be a better value than Tesla was, which just because of the multiple that Tesla was trading at. 15 times the valuation of General Motors, and Cruise offered, obviously, some compelling technology. Of course, fast forward a couple of weeks, Tesla has essentially ridden Elon's star with his association with Donald Trump. Donald Trump wins, and Tesla is taking off much like one of their SpaceX rockets. So this is one of the big challenges, one of the reasons why you don't often hear me talking a whole lot about taking outright short bets, although I will sometimes suggest, as we did in the Elf Estee Lauder case, that you can sell some call spreads in one name to buy them in another, so that you basically cap the amount of exposure that you have on one side or the other. Okay, so where does that leave us with Advance Auto Parts right now? Well, because the company is going to need to make this investment, and obviously they have a lot of work to do to turn things around. This is not going to be, I don't want to sugarcoat this and suggest that Advance Auto Parts can quickly catch up with O'Reilly and AutoZone. One thing I will also point out is that it would seem that if you've ever thought about advertising, marketing for any of these businesses, when's the last time you can remember hearing an advertisement for Advance Auto, or thinking about going into one of the stores, compared to AutoZone and O'Reilly, which obviously have much more of a marketing effort, and that could also be one of the reasons why they are seeing top-line growth that has met or exceeded GDP growth, while Advance Auto has not. Okay, but let's just take a quick peek at what the options market is expecting for this thing, and we can see some very, very big moves are implied. So right now the straddle, it went out, looks like around $6.50. Stock's up quite a lot today, huh? Because I actually drafted my thoughts on this thing over the weekend, and it was around 37.5, so got quite a big pop in it already. But $6.50, so we'll call it $40. So we're looking at 16% implied move. So my thinking was, we're probably going to hear management on the call speak about the opportunity that they now have to fix some of the problems that the company has faced for some prolonged period. I can't imagine that the company's going to have, it's not going to get all the credit for the changes until people actually start to see some operating performance improvements as a result of the changes they plan to make. And, they're only just now realizing the Worldpac proceeds from the sale to Carlyle. Incidentally, there is one other thing I should mention, which is I think they have some form of a credit revolver, which they're going to extend to Carlyle for Worldpac to the tune of about $200 million. So I don't know if that's factoring into that difference between the $1.2 billion in net effective proceeds that maybe they have like a set aside, something like that. But my thinking is, we've talked about these types of strategies before, and I think somebody was actually asking about diagonals. I was just thinking about a straight strangle swap trade for this one, largely because there is just so much room in both directions for this thing. But strangle swaps, as anybody who's been following these live streams will know, tend to skew a little bit bullish in terms of where their profitability kicks in. So I was thinking, this is, like I said, this is turnaround stories take time. Often they take a lot of time to sort of come to pass. So let's just take a look and say, okay, maybe we look at something like a 32.5, 47.5. So this is big, right? A big, big spread for a longer dated strangle, and then selling a nearer dated one against it. And, I happen to be looking at the November regular way simply because it was quite expensive. And the idea would be that you could look to just roll these things over the course of time. I'd prefer to get at least 1% per option sold. So you could sell the 47s, but even these 46s, for $1.25. Let's see what we've got on the downside, on the put side here. We could look at these. I mean, the 33.5 certainly collect enough. This was actually less expensive when I was looking at this over the weekend, so it's not quite as attractive, but who knows? Maybe tomorrow your mileage may vary. This trade could set up a little bit better. I think the number I was seeing when I was looking at this yesterday, based on Friday's closing prices, was actually sub 5 to put this on. But you can see here, basically, this is what we're talking about. A strategy that's likely going to capitalize. I think that the downside, most of the damage, or a good portion of it is in. They could tell us that they had a surprising cash burn, and you could certainly see a move of 10-15%. But I'm not expecting a whole lot more than that, because a lot of people are playing this as a turnaround story. And I would also just leave you with this one idea, which is that the problems at the company could indeed be bigger than just the supply chain thing. As I pointed out, probably most of you viewing this, certainly this is true for me, are more familiar with AutoZone and O'Reilly. Probably the first two ones that we would think of. I mean, I've certainly seen Advanced Auto Parts stores around, but there is a problem that if consumers don't feel like you have the products that they need in stock, or they feel like they're being sold whatever you happen to have in stock, that can create some issues, and that too is going to take some work to reverse. But they are going to be better capitalized to do that net of the Worldpac sale. So I think this is kind of an interesting situation, because there is really a lot of potential here with the right management to turn things around. Now, I will just throw out a couple other things just to think about, too, with the auto parts business in general, because AutoZone really has been hitting on all cylinders. If you were thinking about it just in a vacuum and not playing for a turnaround, they're the ones that really seem to be executing. I would say that we have some, the auto parts business, as we transition to EVs, a transition that may slow a little bit from basically, I think, the path that some people might have thought we would have been on just a couple of years ago. EVs have fewer parts than ICE vehicles do, internal combustion vehicles do. Newer cars tend to be somewhat more reliable than older cars, and much more complicated. A lot more, electronics involved. So, if you were the kind of person who grew up as a kid, as I did, sometimes cars were changing the oil in the garage at home. Much less common these days, but service at the dealerships, very expensive. People are going to keep a lot of these cars a long time. So, if we assume that a lot of these cars are going to remain on the road for a while, even as the transition to EVs takes place, it would not surprise me that these businesses can continue to do well for some time. Okay. So with that, I think we can move on to some of your questions. So James Forbin, I am considering opening a trade on Nvidia's earnings. Okay. You were thinking about, let's see what you have here. Actually, I'm going to put this in your trade. So there's 3 messages here. So I'm going to build up the trade. We can take a look at it. So you're looking at buying the November 29th 145 call. Put that in. November 29th, buying the 145 calls. Times 3. Oops, 3. You were looking to sell the November 29 put credit spread 2 times the 145 130. Okay, I'm going to build this in, but I do want to. So immediately, you have 2 synthetic stock positions in there. Okay, so if you buy a call and sell a put of the same expiration. Same strike and expiration. That's just a synthetic. And actually, you know what? I'm going to do this first because this is, you'll hear people refer to synthetics, and I think this is a very important concept as you go and try to build strategies. If you buy a call and sell a put of the same expiration and same strike, you have just bought a synthetic stock position. That's all that is. So it doesn't really matter. I can leave both in here as January, but I'm going to show you what I'm talking about. And you can see right here, that looks exactly like stock. So this is the synthetic, and that's the common. Now, intuitively, this should make sense to you, and here's why. If you are long a 145 call, and the stock is above 145, you will exercise your long call. It'll probably auto-exercise, assuming you hold it all the way through to expiration. So you will own the stock, the underlying stock, at 145. If you are short a put, and you hold it all the way through expiration, if the stock is below 145, you will be put the stock, and you will buy it at 145. So effectively, you are putting yourself into a forward contract where you are going to, yeah, I see the put spread, but just bear with me for a second. The 145 component aspect of this is just synthetic stock. So what that means is that if you bought stock and then bought the 130 put as insurance, that's the same thing, effectively. And again, we can illustrate that. So I'm going to, now you're doing this on a ratio, so that does alter it a little bit, but I want you to at least, whenever you look at an options position, some things should immediately just pop out at you. And just my own mind is wired in a way that I see synthetics immediately wherever they exist. And that was necessary because as a market maker, we had hundreds of contracts across sometimes hundreds of strikes. So you kind of need to see that immediately. And we would net out any synthetics like that straight away. So it's just sort of automatically wired into me, but it should be automatically wired into all of you as well, that's effectively stock. All right, so let's just take this up for a second. And I realize, you know what, I'm just going to match your expiration just so that there's no confusion. It doesn't matter if they're both the same expiration. Now, if there's a calendar element, it's not the exact same. Okay, but let me just show you now. So here you have your synthetic, and then you buy the 130 puts, and it's going to, what is this going to be synthetically? The same thing as a 130 call, right? So here you go. This is what that position looks like. And I'm only talking now about the two lots. So long two calls and then short two put spreads is the same thing as long stock and long two puts, or the same thing as long two 130 strike calls. Those are all functionally synthetic equivalents of one another. So we can construct this almost any way we want. You could buy the stock and buy those puts. We could just buy two of the 130 calls. All of them are going to have payoff profiles that look very much like this. Now, that doesn't necessarily mean it's a bad thing, right? Buying the 130 calls may be a fine way to play earnings on the long side and limit your risk. If you already own the stock, buying the November 29th 130 puts to insure it might be a fine way to give yourself some insurance. But just understand that that's what you're doing, because, you know, sometimes it's possible to get a little bit too clever. You know, and oftentimes the way positions like this people come up with it is they think, oh, I want to buy these calls because I'm bullish. And then you think, well, I want to help finance it, so I'm going to sell some puts. And then you start tweaking which puts you sell, and oh, that one doesn't bring in enough premium, so you then bring it up, and the next thing you know, it's the same strike. And then, oh, I need some downside insurance in case they get put, and it all comes up like this. This is not a knock on you or anyone. I will just point out that folks who were real options traders never got a chance to speak to Bernie Madoff very often because he was very secretive about his secret sauce. But if you go back and listen to or read what it was that he often said he did, he would refer to split strike conversions. So he would own the stock and he would sell an upside call and buy a downside put to protect it, which, by the way, is synthetically the same thing as buying an in-the-money call spread. He referred to it as a split strike conversion because he probably told somebody who knew a little bit about options that he was buying stocks, selling calls, buying puts to create insurance. And somebody said, wait a minute, isn't that just converting? Which is exactly what it is. So options traders will say if you buy stock and then sell a call and buy the corresponding put of the same expiration, that's just a conversion. You're swapping synthetic stock. So you're getting short the synthetic and long the common. So you have no real delta. It's just a carry cost trade. So, and again, this is fine, but it might be complicating things just a bit too much, right? So, anyway, all right, let's just take a look at what your strategy ends up looking like. So we're going to go to this one. This is where we were constructing it. So you were going to do this 2 by 2. So you're going to sell 2 of the NOV 145 puts, and then buy 2 of the 130 puts. So that's the 2 put spreads, okay, that you were going to do. And this is effectively what your strategy looks like. And you have a little bit less downside than you do upside, and you have hang on. Make sure I've got that in there right. Sell. Oops, sorry. There we go. Yeah. So you're gonna have. Yeah. Thank you. Good catch. Knew there was something wrong there. So you're gonna have a little bit less downside than if you did this 3 up, right? Because you're short 2 put spreads. But the one way to think about it is, effectively you are long one. You're long 2 130 calls in the money calls. And then 1 additional 145 call. That's another way to kind of think about it. That's effectively what your position is. The thing I would also think about here, I mean, I guess what I would say is that simplicity, we generally favor simplicity, right? So I'm not sure why you would go about doing this synthetically with those combos, as we sometimes call them, or the synthetics. Let me just illustrate that you could do the exact same trade here by purchasing the 130 calls 2 times and buying the 145 calls. So that's the same thing, as you can see. And that's a simpler construction for the same outcome. So I hope that helps. I will say, look, at the moment, I would probably only at this point be interested in having some convexity on the long side around Nvidia earnings. They're the only game in town. I was just talking over the weekend with somebody else about this. I don't know. We don't have good frames of reference in history to look at compared to companies like Nvidia and the growth that they've seen. Consider that next year, like the full 12 months for next year, the company's going to do over $100 billion in free cash flow. And they've got margins, gross margins of in the mid-high 70s, and net income margins in the mid-high 50s. I don't know that there's ever been anything like this. You know, Ford in the early 20th centuries, you weren't getting anything like that. The railroads, I mean, the things that created the robber barons of the late 1800s, they weren't getting those kinds of margins. And so quickly. But you've got to think that anybody who can come up with a competitive product, and I'm not saying that's an easy thing to do, but it's $1 trillion business to come up with something that competes with NVIDIA's GPUs. And you've got to think that the brightest minds available are thinking exactly that. So will this last forever? I mean, that's the real difficulty, is that you can't... and actually, let's just take a look at one other thing, because I think this is kind of important. So it is not that I think that the company is trading at an absurd multiple to forward earnings given their growth rate. I don't, right? So what do we have? We've got, so 2026, if you're looking at my screen right now, let me blow this up a little. If I can remember, what do I need to do? Oh, okay. So it's been blown up. Thank you. So $145 a share. We're just going to use round numbers. Even if it was just $4 a share, that's 36 times next year's earnings. And I realize it says 2026, but understand that their fiscal year ends in January. Well, 36 times forward earnings when you're growing at 50% a year, which is what that would represent. And it could be that rate of growth or higher, right? Because recently they've been growing at a faster rate than that. That's not absurdly priced. So when I say it's expensive and I'm expressing some reticence to just pile in to it here, it is not because I think 36 times $4 a share is an unreasonable valuation if you're growing at 50% a year. What I'm saying is that the combination of these margins and this growth rate at this scale, right? So a $3.5 trillion company, we don't have a frame of reference for something like this. It just seems hard for me to imagine that a single company is just going to run away with all of what we think of as the hardware requirements for artificial intelligence, which is going to be transformative. I fully believe that. Indefinitely. In the same way that everybody thought the same thing about Cisco back in 2000. The internet's going to be transformative. They were right. It was. It's absolutely transformative. But they also believed that Cisco was basically the keystone in all of it. The Internet of Things, anything internet, Cisco was going to touch it. We use very similar language when we think about Nvidia now, and that's the reason that I'm concerned about it. So absolutely, you want to play it on the long side, that's fine. The valuation, assuming these growth rates keep up, is actually not insane. It's not trading at the 80 times forward that Cisco was back in the day. But what I'm saying is that 75% gross margins, 56% net income margins, 100% per year growth rates on $3.5 trillion businesses. The law of large numbers, and there's a lot of large numbers that I just cited here, is going to catch up with this thing sooner or later. It has to. If it does not, here's another way to think about it. If that growth rate persisted, it would not take long for Nvidia to be as large as the economy overall. And that's not going to happen. That's just my 2 cents. Okay, so hopefully that's helpful. Steve Garcia would like clarification. When buying a spread, should try to get 3 to 4 times the width or profit. Consider a $10 wide spread is a good price. 3 times profit, meaning pay to an. Okay, so let's talk about that. It depends a little bit, but let me give an example. In this case, I'm going to use a hedge as an example. So we often like to use put spreads on index when hedging, and the reason we like to do that is because due to skewness, those downside puts often make the math favorable, meaning that you get good payoffs. So let's just take a look at an example and see what we can construct. So let's just assume we were going to go to the end of the year, so December 31st. SPY closes. Oops, and these are going to be puts, so just let me do a couple flips here just to get this in line. SPY's around $600, so let's buy something that's a little bit out of the money. Maybe I'll buy 595s. Okay, so that's very close to at the money, right? And then we're going to sell something a little further out of the money against it. Doesn't really matter what I'm going to choose for purposes of illustration, but you set a $10 wide spread. So here we go. 595. Oops, that's not 10. Make it even easier. We'll just go 595. 595.80. There we go. All right. So here we are. So this is what you're talking about. So $10 wide spread, spending just over $2 on that spread. So the max profit is almost $8. Let's say that it was 2 and your payoff, the max profit is therefore potentially 8. So the most it could be worth is 10. You're spending 2. So the most you can make in terms of profits is 8. That's a payoff of 4 to 1. My point when you are using options on the long side is that usually we're seeking some benefit in the form of convexity. And that convexity can come in two ways. It can come if you buy a single option, like a 30 delta call or a 30 delta put, and you just risk the amount that you're spending, but you have unlimited gains if it's a call, and theoretically much larger gains to the downside if it's a put. And that's the whole reason that you're using options, is to get that asymmetric payoff. Well, when you use vertical spreads, if you're hoping to still get an asymmetric payoff, the way you're going to accomplish that is by getting something like this, where you're getting 4 to 1 or 3 to 1, or at the very least something like 2 to 1. And this is important for another reason. With vertical spreads do not go to their full value simply because the stock migrates down to or through your short strike. So for example, in this case, if SPY drops tomorrow to 575, this spread will not be worth $10. It's not going to be worth anywhere close to $10 at 575. And we can actually get a sense of that by recognizing that debit spread, now if it's completely in the money, is going to be functionally equivalent to a credit spread on the upside. So we can actually guess that, maybe that call spread, if SPY was 575, how much would the 580, 590 call spread be worth? Because remember, if I combine a call spread and a put spread, I'm really creating two synthetics, right? Those combos I was talking about before. So the value of those two spreads has to sum out to something close to $10, with minor adjustments as a function of things like carry cost. So if we think that call spread in that case would be worth, call it 30% of the distance between the strikes, 35% of the distance between the strikes, that means that the put spread could only be worth about 65% of the distance between the strikes, or $6.50. So I spent 2, now it's worth $2.10, call it, $2, whatever you executed at, and now it's worth $6.50. That's a good return, of course, instantaneously, but it's not going to be the full number. So when we're dealing with these vertical spreads, one of the reasons you're looking for these payoffs is because also not until expiration are you going to get the full value. So, a little bit more of that, a better payoff ratio is going to improve that a little bit if convexity is what you're looking for. It doesn't always have to be that way, because there can be circumstances where the only reason you got into a vertical spread was to define your risk and to mitigate decay. And the perfect way to do that would be to just pick 2 strikes that surround the current price of the underlier. So for example, I could just say, okay, well, if I wanted 580, 580's got $4.72 worth of extrinsic premium. If I want a clean offset, I could pick an in-the-money strike. So we're at 598.72 that has something similar to that in terms of extrinsic value. Like, let's see, something like that. And let's see, what are we at? 606. So we'll call that $7, 7, 5, not, that's pretty close, right? So it's going to be either the 606 or the 607. And you're going to essentially get no standstill decay, right? That would be again, this would be another reason to use a vertical spread where convexity is not the objective, but the objective is just to get rid of any standstill rate of decay, and cap your, define your risk. So if you just took a short bet in SPY, obviously unlimited risk. So this is another way to think about it. But when I'm making a directional play with call spreads going into earnings, yes, I'm looking for payoffs that are going to be better than 2 to 1 in general. I like 3-to-1, so that means you're spending 25% of the distance between the strikes. You're always going to be... So here's the trade-off. The trade-off that you're making, because you could easily go hunt for things that have 8-to-1 payoffs, but the trade-off is that they're going to have a very low probability that they're ever in the money. This one's already in the money, so you don't get that payoff. You're just trying to mitigate decay. So where you strike that balance is going to be a little bit up to you, but in general, for me, if I'm making a bet using a call spread on a directional trade going into a catalyst such as earnings, 2-to-1 is probably my minimum, because I am looking to make more than I lose. And there's another reason, which is it's hard enough to get the direction right in the first place. So if you imagine you play that game a lot of times, if you're not getting a good profit when you get the thing right, it's just going to be a lot harder. Okay. And otherwise, you might as well just play with the stock, right? So that's something else. And sometimes that makes plenty of sense, because in general, everybody's long stocks is a normal course of things. You begin using options because there's something else that you're trying to get out of it. Either you're trying to get income, or you're trying to get leverage, or something along those lines. Otherwise, just straight stock is fine. PC says, is there a screen of stocks close to their 52-week highs with stock buybacks remaining for this year? I am thinking people are not going to sell their winners until next year. Well, okay. So it's definitely true that for tax reasons, and this is interesting, because if everyone was expecting that there was going to be an increase in capital gains taxes, for example, and if the election results had turned out differently, they might have expected that. Probably would have been difficult to get that change in place by the end of 2025. I mean, it certainly would have been possible. It depends on how Congress would have gone. But it's less likely now, because people are not anticipating tax increases. Trump has repeatedly said that he was going to try to make his tax cuts permanent. He's also talked about reinstating the SALT deduction. So that, combined with the fact that deferring your taxes in general, all else equal, is usually something people would try to do, that does make sense to me. Okay, so we'll start with that. With respect to buybacks, let's see what we have here. I don't know if on this one, it takes me a little while to pull this stuff up, what we've got remaining. So let's take a look. And I might have to we might have to take this up for Wednesday. I'm just going to see if I can find a couple of things where there are relatively recent buyback announcements, because the recent ones are all going to have a decent amount remaining. And it is also true, by the way, that it's not uncommon to see buybacks. Now, you can be conspiratorial about this if you want, but we do often see buybacks sort of ramp up a little bit towards the tail end of the year. If that happens to work out nicely for people whose compensation is tied to the performance of the stock, to create some incremental measure of support. So you put those two things. Look, it's a good season for stocks. These are all contributing factors, right? People want to defer the taxes, and now they have more of a reason why they would do that, because the taxes are not going to be as... Again, not providing tax advice. I don't know exactly what Trump's administration is going to do and what Congress is going to do, but it does seem reasonable to assume that increases in taxes are less likely now than they were, right? So here there's a lot of stocks in here that have had recent stock buyback announcements. Let me get rid of these. I don't know why some of these they're here, but they're not showing values. I like to look at it as a function of the size of the business as well, right? So if you have, as we have here, a market capitalization of, call it 2.6 billion and a $600 million buyback, although this could be over a much longer period of time, right? That's going to be material. In the same way that, the accretive effects of the buybacks from Apple, Apple's buyback program is immense. But because the company has grown so much, it's not as accretive as it once was, because as a percentage of the overall shares outstanding, it's not as important. But I do agree with you that this is generally a good time to be long stocks going into the end of the year for all of these reasons and others. Okay, so I'll look at some of that, and we'll touch on it on Wednesday and see if there's anything more interesting. Gold has retraced 6.5% in November. Healthy pullback or cause for concern? I'm generally bullish. I fear inflation. Yes, so I also agree with you. I think we are in a potentially inflationary environment. I don't see meaningful conversations being held about our fiscal imbalances, and this is problematic from an inflationary standpoint. We're also hearing a little bit of hubbub about the independence of the Fed. Powell has said if he's asked to resign, he won't. There's going to need to be independence. There would be a massive uproar, I think, if that wouldn't happen. And besides which, anybody could show President-elect Trump the history of what happened when the closest thing to executive branch intervention in the Fed took place when Nixon was president and Arthur Burns was chairman of the Fed. And that was not a good outcome. There is no, in government, there's no history when politicians get their hands on money and their ability to print it that it turned out well. It just doesn't. So while they might want that power, it's not a good thing. The thing is, though, that they kind of exercise it anyway, and the way they do that, if you pay your debts in your own currency, is you just assume debts, because eventually you kind of have to print your way out of it. That's one way to do it, and arguably without a real game plan for resolving these fiscal imbalances, it might be the only way. So that's inflationary, and to me that's bullish for gold. I will also say, though, that the incoming administration is arguably more bullish for crypto, and I think that's what's happened is that, and we see that too, right? When at the beginning of the year, when I came up with that BRAVE acronym, so that was the, Bitcoin, real estate, AU, for the periodic symbol for gold, value emerging. That was what that was about. It is not a pairs trade, but a barbell, right? So you have two things, and you have a general thesis, and both of those things, in this case, both gold and Bitcoin, were intended to be plays against this dynamic. $88,000. Wow, just amazing. So, as you look at this, I am still bullish on precious metals, but the fact is that a government regime that is more accommodating for crypto, and the incoming administration has said everything right. As if you're a Bitcoin fan, everything they've said is something you wanted to hear, right? They talked about kind of a reserve, making it part of the reserve currency kind of thing. So when you think about it, it's just more bullish for, I guess the way to think about it, it's more bullish for crypto and for Bitcoin specifically than I think it has been for precious metals. But I remain bullish of both for that reason. And they maybe they did get a little bit stretched, but I still like them. Okay. Gray's Television. Oh my goodness. I see that one in there. Where are we? Would you buy common shares now? Michael Anthony asks. Are you referring to... Yeah, what are you referring to there? Oh, that is about Gray's Television. Okay. Would you buy the common in Gray's Television? Yeah, so this is really interesting. I'm going to just put this in here. Gray's Television. Okay. So there was some, I don't know, did we talk about this a little bit last week? We might have been talking about it in the context of Sinclair. So Sinclair, and actually it's not just the television station operator. So incoming administration, more business friendly. I think we can agree on this. There is some hope and expectation that they might be more accommodating for television operators and relax some of the rules so that they could potentially merge and do things like that. They probably need some additional latitude because the landscape is changing so rapidly that a lot of these businesses, if they just aren't, I don't know how they can really continue in some cases as going concerns. Let's take a look at Gray's Television as an example. And this is kind of an interesting case because I was thinking to myself, oh yeah, they could relax the potential mergers, and Gray's Television, the valuation of this business has just absolutely collapsed. You can see here it's got a $470 million market capitalization. This was a business that was worth a couple $billion just back in 2019. Now, here's the problem, right? You're saying to yourself, oh, well, I mean, even just as a call option. I had somebody say that to me last week. I was talking about Gray's Television, actually. They said, oh, well, it's just a call option. Is it? Well, here's the problem. So take a look at the enterprise value. So the enterprise value is going to effectively be the value of the business when you factor in its equity and its debt. And and that was with a $2.1 billion market capitalization. Well, fast forward, the company's taken on a lot of debt. It's got about $6 billion worth of debt right now. So the business, even though the equity is worth less, the enterprise value is actually higher. And here's something that I also thought was kind of interesting, is that take a look. Let's just compare this to Sinclair for a second. And I realize these aren't immediate and perfect proxies for one another. But we'll just take a look at Sinclair Television real quick. Where's the equity? Here we are, Sinclair. So let's just think about this on either a revenue to enterprise value basis or an EBIT to enterprise value basis. So here's the interesting thing. Sinclair's going to do full year maybe 3.6 billion in revenues, and Gray's is going to do about the same. Now, it's only a $470 million market capitalization versus $1 billion for Sinclair, but take a look at the enterprise value. This one's less than $5 billion. So even if the equity was wiped out entirely, and if Gray's can get to an EBITDA margin, if their EBITDA margins are about the same, even down here with less than $500 million market capitalization, this thing is actually trading still richer than Sinclair is. And look how much cash they have on hand, $69 million. And obviously if they can keep these free cash flow numbers up down here, that's fine. But boy, on $6 billion worth of debt, having 1% of that in cash, that's a little sketchy. So check this out. You could say, well, maybe, what if you bought the bonds? And so let's take a look. And you can see, by the way, anything that's less than BBB minus is what some would call more speculative grade. The other name for that is junk bonds. Okay, so just bear that in mind. So let's take a look at these Grays 4 3/4. All right, those are trading at 58 cents on the dollar. So if you buy, now I don't talk about buying bonds too often on the live stream. We usually talk about options, but it is something to think about, that if you really think that a business has the potential to turn around, sometimes the bonds could actually be a better way to play it. First of all, if you're buying something more senior, especially the most senior, you can probably assume some measure of recovery in the event of bankruptcy, liquidation, or whatever, right? So just round numbers, assuming the business has some assets, just call the most senior debt is going to get 40 cents on the dollar. Now, that's going to vary dramatically from one business to another, but it's kind of a rule of thumb. So you kind of think to yourself, okay, in the event that everything goes to hell, I buy a bond for 58 cents on the dollar with a 40 cent on the dollar recovery. Well, that's my downside, right? So my downside is, 20, we'll round it and call it 60-40. So my downside's about a third for every buck I put in, right? So for every $60 I spend, I could potentially lose 20, right? Lose 33%. That's my downside. The upside is that I collect my interest and then ultimately maybe get a full recovery. Now, if you are put the assets and it converts to stock, which sometimes happens in a liquidation, and then that you can turn the business around after it's restructured, well, then, of course, you could have materially more upside. And I'm not saying that's the case here. I'm just saying that in the case of Gray's Television, when I look at that balance sheet, I'm not so sure that even at this depressed level, $6.8 billion enterprise value, 2 times, let's round numbers. We'll just call it 2 times revenues. And I compare that to Sinclair, and I say, well, which one's a better bet? It's, to me, it almost looks like the equity in Sinclair looks a little cheaper to me than the equity, because you're subordinate in the cap structure, right? You're the last guy to make any money. All the debt holders have to get paid first. So I'm not saying the company's going to file for bankruptcy. I'm just saying it's a speculative investment, as the bonds indicate. You could buy the bonds for 58 cents on the dollar, carry those things to 2030. So that's, we'll call it 5 years from now. And, you're going to make over 100%, assuming that they pay. And you're senior in the cap table. Just a thought. But it's a difficult business. I mean, I think that deregulating the industry is potentially going to help out a lot in this one. So I hope that is helpful. It's funny that you mentioned Gray's Television, because I've looked at these businesses on more than one occasion. I've thought, can these things get any cheaper? The problem is that they're just businesses in secular decline. And, you're trying to catch a falling knife. I have a feeling that the debt's going to be a better way to play it. I would like to see some form of deregulation, though, because then they have more operating flexibility. They can look to spin off underperforming assets and to others that might be able to do more with them from a synergy standpoint, where they might have some regulatory hurdles to doing that now. Okay, this is gold. That's the gold question. Michael Anthony, what's happening to Pfizer, which made $1.06 and raised their outlook on earnings? This is, my issue with Pfizer is that, let's take a look at their operating performance over the last several years. I'm just going to move this over this way. All of the value that got added to this business within recent years was vaccines. They just have not done anything effective with their pipeline. They had these vaccines turned into a rip-roaring business, but if we go back in time and take a look at how the company was operating before these vaccines sort of came to the forefront, this is the picture you get. From 2015 to 2019, the top line actually dropped. It would look at a 5-year history. We have not given back all of that. There are some people who are still going out and getting Pfizer boosters and things like that, and maybe there are other places of utility for these mRNA vaccines. Same thing true for Moderna, of course. But this is a company that had not, for a decade, had failed to demonstrate that they could meaningfully develop out their pipeline. And to me, the vaccine thing, they got some immunity there. If these things proved either not to be effective or in fact proved to be dangerous. But the fact of the matter is, it's their underlying business that I think one needs to rely on. It's not a name I'm particularly interested in myself for that reason. But you know, you can look at it the way you will. I mean, if they are able to pull off the numbers that the street's expecting full year, that's $2.90 a share, so it's single digits. And what are we looking at for next year? The consensus is around the same number. Decent free cash flow. The free cash flow yield obviously looks very, very good. These numbers that the street's expecting are not what the stock price is implying. So I would say, some people like to play in this part of the pool, where you're buying these potential value traps at multiples that look extremely attractive, and 10% free cash flow yield, that looks terrific if it's real. But things don't trade this way if everybody thinks that that earlier bunch of forecasts is legit. My guess is that those forecast numbers are going to come in still further. $16 billion in free cash flow, probably not. Although, look, sometimes that does create some margin of safety. So even, what would be a fair number? Let's cut that number in half, and so you have 6% free cash flow yield. That's not absolutely horrendous, but I don't expect what you got out of the pandemic, where all of a sudden, they were just in the catbird seat and had what everybody needed and wanted. So it's okay. It's not for me, but it's most of the damage is probably done because we're getting close to that level, getting back to that level. Okay, Mike, any trade ideas on the overextended financials, which I'm bullish on, or have they run too much? Too much, I think. And I was particularly concerned, I have to say, about names like Bank of America, although it didn't pop as much as JP Morgan did. I mentioned this before. They have a lot more duration on their HTM book, and this is inflationary. I don't see anything that sort of flies in the face of that. Especially, I mean, if Trump gets, and it's looking increasingly that way, so he gets Congress, he's got the Senate, he's basically able to do whatever he wants. He's a debt guy. He has been in his own business a debt guy forever. He was when he was president the last time, and everything he's talking about now suggests that. It's a separate question whether you think that's the right thing or the wrong thing. We definitely need to focus on growth because no debt problem will be solved without it. But that's inflationary. So names like Bank of America shouldn't pop that much. Morgan Stanley rose more than the market. I found that interesting, right? Because they're essentially asset management. We talked about this last week. JP Morgan and Goldman will theoretically see a benefit in other areas of their business which are not baked in, which is to say their operating performance should improve because you're going to get more deal making than we've had. And that's what everybody's, we haven't had the IPOs, we haven't had as much M&A. Those are things that JP Morgan and Goldman could definitely capitalize on. And they're not hugely expensive, but they're up there. JP Morgan, I didn't look at it today, but on Friday it was trading 2 times tangible book, which is the upper end of the range over the course of the last 20 years. And so, hugely expensive, on a price to earnings basis, no. On a price to tangible book basis, yes. And so, yeah, I think they could potentially be, pull back. So RFK Jr., that's interesting. Yeah, so Steve Garcia is saying that, RFK Jr. being the forthcoming health czar. Yeah, not... I think we could all say this guy is not... It's not like he's running around banging the drum saying more vaccines, please. And that's kind of their thing, right? So that's... maybe it's a little bit of a wait and see. Although it is cheap, right? So... credit spread, what do you look for? 30 to 40% minimum, generally speaking. On the upside call spreads or downside put spreads, but 30% seems like a good sort of floor. we're talking now about, presumably out of the money. But yeah. Okay. Interesting on Nvidia. A gentleman who works there mentioned one of their advantages versus AMD is software for their chips. Wonder if Microsoft, Google, Amazon are working on AI software. Yeah, I mean, AMD is often talked about as the CEO. She's always talking about how they're going to be cooking with gas on the AI thing, on the AI train. Now mixing metaphors all over the place, and I think that they're going to figure this out and develop some stuff that's going to be important for the process. But it's hard to play catch up. I know someone else is going to come on. I don't know whether it's going to be a legacy player like that, like an AMD, or know whether we're going to have somebody emerge from some dark corner where they're working in stealth mode right now, and suddenly they have something new and exciting. I imagine we will see that sooner or later. But yeah. And I've been looking at ConAgra Foods. I'm just skipping ahead here, Michael Anthony. So this is, I kind of like where your head's at. It's kind of the same reason I was looking at AAP. The problem is the market's at basically peak multiples with a couple of exceptions, but we ignore. Let's do this. We're going to end on this one quick theme, which is, and so you're going to have to look at these charts and kind of read through it with me a little bit. But what I'm going to do here is I'm just going to put price to earnings here, price to forward multiples, price to, so we're just going to put, this is an estimate, get rid of the price. I don't want you to think about the absolute level of the underlying index because that's not really all that important when we think about valuations. And I'm going to simplify this. So we're just going to look at price to earnings for now, okay? And I'm just going to draw a line where we are. And somebody could look at this and say, well, look, Mike, that's not all-time highs. Because, look back here. We had higher price to earnings. Doesn't count. Why doesn't it count? Because earnings, the reason this spiked was not because valuation shot up, but because earnings collapsed. So I think I can pull in the earnings per share, basic earnings per share. There we go. So this will help reveal what I'm talking about. Okay, so this is where we are in terms of valuation. Notice that you got this big spike here, and this actually rolled over. The truth is that most companies didn't, not all of them saw this kind of a pullback. What happened was you had a handful of businesses that had massive losses, like the Carnival Cruise Lines of the world. Go back to the GFC, the financials, massive losses, and that dragged it down. So you got this spike. We are, if you exclude that, in a realm that's only been exceeded during the tech bubble. And the tech bubble was a handful of companies, not every company. So when you have the 10 biggest companies trading at 100 times earnings plus, well, that's when you get something like this. Right now, we have so many companies that are trading at the upper end of their historical valuation ranges, including, as we were just talking about, financials, and I was just looking at it on a price to tangible book basis. And, when things roll over, everything falls, including the book value, right? So that is, it has me a bit concerned. I still think I don't see any reason why we should roll over, between now and Christmas. Of course, anything can happen, but because of buybacks, because of withheld selling, people, deferred sales because of tax reasons. Tax loss selling is going to get rid of the weak stuff, but not the strong stuff. But I do think we are in a vulnerable spot on a valuation basis. I think we also are in a much better position in terms of economic growth, right? That we for sure are better off now than we were before the election, because I had said a couple of months ago that the corporate income tax proposal that Kamala had proposed was probably going to count by my work to about 6 to 7% impact to S&P earnings. So if we just aggregate that, and we're not going to get that. And now we're actually hearing about potential corporate income tax cuts. I don't know if that's going to happen. I'm not sure that makes a whole lot of fiscal sense. But if you did, that's a potential tailwind. a lot of things that could create a lot of growth. But we're getting right in there. So I totally get why you're looking at things like ConAgra, which is one of the reasons why I look at turnaround stories like Advance Auto. Like any piece of junk we can find and say, is there any way that this could be the next turnaround story? Because hopefully we can find stocks that look like they are due to at least double. Now that sounds ambitious, but the truth is we get enough things wrong when we try to value businesses that if you sit there and say, oh, I think this $100 stock's worth 120, well, we're working with limited information. So we're really hoping to find circumstances where we could see 2, 3, 4 baggers, which AAP, if they even just got part of the way to an AZO or an Orly, that's what you're looking at. But it's speculative. Or, you could buy the debt and something like the Gray's Television we were talking about. That's 100%. It's senior in the cap structure, but a declining business, but potentially 100% over the course of 5 years. Not terrible. So I get it while you're looking at these things. But we're going to get into this a little bit more when we come back on Wednesday at 4:15 Eastern. And I see there's a question here about PayPal. I will look at PayPal. We'll look at ConAgra a little bit more. Let's see what else we're going to try to touch on Wednesday. XLRE. So we're going to have a data center. That's a good point right there. So we took a look at real estate, look at data centers. Notification bell, subscribe, tell your friends, and come back Wednesday, 4:15 Eastern. Thanks for watching.